guys, in this video we'll be talking about price action basics. So price action is the purest form of market analytics. It is built on the idea that price itself reflects the information. Instead of relying on lagging indicators, trader reads real candle and real support resistance patterns and real market structures, and it is just the raw chart, the date versus the price. Every candle is a footprint of a trader's psychology, showing momentum, hesitation, or reversal. By mastering price action, you can really spot trends, reversals earlier, identify high probability entries and exit, and trade with clarity and confidence, free from the lagging indicators problem. Now, starting off with price actions basic. Why traders generally use this price action? So price action, price reflects all market information, news, sentiments, order and flows. Change in news, change in sentiments and change in orders can cause movement of price, and thus it can be shown on the chart, and you can analyze your setup depending on the price and date. Next, what are its advantages over indicators? Indicators are generally lagging. Once the market has done the move, then the indicator starts applying. Let's take RSI. It gives, let's take RSI of setting 9. It gives last 9 candles average. So once the next candle is formed, after that RSI gives the confirmation. So indicators are generally very laggy, but price action is very clean and it works across all time frames and all the markets. Next, what is market structure? How is a market formed? It is generally, only 3 types of movements you'll ever find in the market. First is an uptrend, where market makes continuous higher highs and higher lows and it keeps going upward direction. This is called an uptrend. Next is a downtrend, where market makes lower highs and lower lows and it keeps going downward. And the next thing is consolidation. This is a choppy side range market where market is moving between 2 zones, like between a support and resistance or between any zone. So only these 3 things together make up the market's movement. And what does they indicate? Uptrend indicates that there are high number of buyers and there are low number of sellers. Consolidation indicates that there are equal numbers of buyers and equal number of sellers. Downtrend indicates there are more number of sellers. Now, uptrend, as I said, it's already made of higher highs and higher lows. Downtrend is made up of lower highs and lower lows. So in an uptrend, buyers are in control and it is a bullish momentum, whereas in downtrend, sellers are in control and it is a bearish momentum. And now, what is consolidating markets? When markets consolidate, it's also called as range or sideways market. We will call it choppy markets as well. Occurs when price moves between 2 horizontal levels. There is a support and resistance, in small gap. If you see the pips between this, it is less, it's like 10 or 15 pips. And market is continuously moving in this gap without giving a breakout. So this is called as consolidation choppy market. And in this, don't force trades. We should never trade when the market is choppy. Always trade when the markets are in trending directions, either upward or downward direction. Next, what is a support and resistance? I had made a detailed video on support and resistance candlestick patterns. If you want, you can check it out. You'll find it at the end of this video. Make sure to watch it as well. Now, what is support? Support is basically a zone where, buying pressure is very high. Historically stops price from falling any down. Let's imagine this is support. Whenever price comes to this zone and goes up, buyers get activated and it goes up. It avoids the price falling below this support. And resistance is a zone where sellers are high, which sellers are very active. They do not allow the market to go above that zone, and they start just reversing it from there. More times the price is tested, the stronger it becomes. Now, the more you can see this support is tested like 1, 2 and here 3 times. The more number of times it is tested, the stronger the support is. Next, draw zones, not lines. Because for beginners, if you see this, draw a line near the support and a line near the resistance. Line is an exact price value, so it can differ. It can cause some problems. Sometimes support might take from 1 to 2 pips above or below. So what we should do is we should generally draw rectangular support and a rectangular resistance regions. And next thing, what to do when the market is consolidating, how to trade. First thing, we should never trade when the market is consolidating. You should trade when there is a breakout at a key level, and there is a false breakout risk as well. Generally, traders don't trade in consolidating markets. When it breaks the resistance, they generally enter here, or if it breaks the support, they generally enter here. And sometimes this breakout can be fake. Once it breaks the support, it might again go back and start consolidating within these zones. So this is called as fake breakout. Now we should combine it with few other things to make it strong. First thing is a reversal, strong bearish candle signal. Either you have good candle confirmation, or you have good momentum increase in volume, or you can trade with a momentum breakout. A breakout with increase in volume and a good momentum can be a good setup as well. Or you should wait for a confirmation that this breakout is not a false breakout. Next, for confirmation, a candle close before acting. False breakouts are common, patience filters them. False breakouts are common, patience filters them out. So this is very important. Next, you can combine, candle patterns and chart patterns. These are traders' raw signals. I already made a detailed video as I told you, but here I'll discuss three important ones. The first one is a pin bar candle. It is generally a long wick, like you can see here, the green one, long wick and a small body. It is a signal of rejection at the price. And next is engulfing pattern. Engulfing pattern is like, it's of two types, bearish and bullish engulfing. First thing is bullish engulfing, when a small red candle is there and a big green candle completely engulfs it. Means the top of the red candle to the bottom of the red candle is completely engulfed. Then this is called as bullish engulfing. And this is a good sign that the market is going to go in the larger candle's direction, green. And if a small green candle is there and a big red candle completely engulfs it, like it completely encloses the previous candle, it's a good sign that market is going to go in the downwards direction. So this is also a very good sign of confirmation. Next thing is Doji. Doji is generally called as a confusion candle. What happens here is buyers and sellers both are in equal power, so it causes a problem. It is a confusion candle because you cannot go long or short. It confuses everyone in the markets. Next, putting it all together, how do you set up a trade? First thing, you identify the trend. Always trade with the trend, don't go in the opposite direction of trend. Next, you find some key levels, either order blocks, support resistances, or liquidity sweep zones. Next, you wait for a confirmation signal and then you enter the trade. Now, risk management. This is, it protects your capital. This is the most important thing when it comes to price action. First thing, always use a stop loss. Stop loss is your very precious tool. And always place a stop loss when you enter a trade. Let it be a small trade, large, big trade, big capital, small capital. Always use a stop loss. Because sometimes if someone tweets, Trump's tweet comes or something like that, a sudden move in market can wipe out your entire capital. Next thing, always use a risk reward ratio. And use it minimum of 1:2 risk reward, so that at a long run you'll be profitable. Next thing, position sizing. So in a traders community, there is generally a rule that you should risk 1 to 2% of your total capital per trade. So generally don't risk more than that. And next thing to remember is price action is a skill, but through screen time and discipline it is built. Master structure levels, candles, and then trade with patience. You cannot master price action just casually getting on the screen and trading for 1 or 2 days. It takes long screen time, discipline, and it takes people generally takes years to master this. So yeah, that's it for this video. If you have any sorts of doubt, you can ask me in the comments, or my Instagram link is in the description. You can ask me in my Instagram as well. And yeah, that's it for this video. Happy trading.